Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I am continuing the series on answering and responding to comments from people on the YouTube channel. Now, this comment is from my video, 4 Lies Insurance Agents Use to Sell Index Universal Life, the 2023 version. I like to do an updated version of this video all the time, like on an annual basis, because of the fact that IUL is constantly evolving and shifting, regulatory changes happen, and agents and the stories that they use to kind of mislead and misrepresent how IUL actually works is changing constantly. And so I like to do an updated video on what that looks like. So the 2025 version is going to be coming out soon, so make sure you subscribe and hit the bell, that way you're notified when that video comes out. But for this video, let's talk about this comment. A couple days ago, at the time I'm filming this, there was a comment that came in that said, very helpful, great organized talk, Chris. Thank you. Would you please make a video or simply explain the fixed index universal life due to taking the risk off the market fluctuation? Is it better or not than IUL or whole life? Thank you. So here's the deal. I've done a lot of videos on this, and what I want to say to this, so he's asking simply about fixed universal life versus IUL. Here's the deal. Fixed universal life was created in like 1981 by E.F. Hutton. It had a run where it was really popular. If we go back into the 80s, we obviously had high interest rates, and so the crediting strategy in a fixed UL, with the way that the general fund puts money into the fixed crediting with the UL, the illustrations with those ULs looked really, really good, because when you have annual renewable term, which is basically the foundation, it's the platform of how a universal life policy works. It's a blend of annual renewable term with a cash value component to it. One of the components with all UL platforms that are important for everybody to understand is that they are cash value insurances, but they are not permanent insurances. In order for it to be permanent, you have to look at the guaranteed column, and the guaranteed column has to be guaranteed to be permanent forever for the entirety of your life. Most UL platform chassis products are not permanent because they are not guaranteed to last, right? And so that's important to understand. Now, the question is fixed versus IUL. Well, fixed UL has been around, for 45 years almost, and during that period of time, it's proven that it just doesn't work. It's not better than whole life because of the fact that you have all these variables that are changing. It can offer a little bit more flexibility, but there's also a lot of costs that get really out of control as you age. It's cheaper in the younger years, but in your later years, when you need to utilize it the most, it can get dangerous. Now, there are certain situations with products like Guaranteed Universal Life or IUL with guaranteed riders that will insure and make sure that the insurance is guaranteed. That can be utilized as kind of like a forever term insurance for people that are doing legacy planning. IULs can be better than GUL if you want to use that like forever term insurance, or that perma-term, as I used to call it. If you want to do that, and you make sure to insert the guaranteed riders so it's guaranteed to be there forever, and then you pick up living benefits and you want to utilize it for that while you're younger, that's fine. The challenge then comes if you utilize those products at all for the cash value, the whole concept blows up. The biggest misrepresentation of IUL, for instance, is the fact that it's this great tax-free retirement vehicle, and that's where the wheels come off. There are use cases for IUL. It is not ever for growth of your cash or retirement income planning. That's where the danger happens. And in my new book, IUL Exposed, The Truth About the Most Misrepresented Product in Financial History, I cover all these details. So, make sure you subscribe to this channel. Once again, hit the bell, that way you're notified, because when that book comes out in February, you're gonna wanna see it, you're gonna wanna read it, you're gonna wanna share it, because it's gonna be one of the most disruptive books that has ever hit this industry. I promise you. All the people that have been kind of trolling me and hating on me and all these things about my take, thinking that I hate IUL. I don't hate IUL. I hate the way it's misrepresented by all these influencers that don't know what the heck they're talking about. That's what I hate. And so when it comes to the UL versus whole life, we've been proven over the past 45 years that fixed UL does not beat whole life. That's just been proven. Now, when it comes to IUL, remember, IUL is simply a fixed UL with an options strategy attached to it. That's it. A UL product with an option strategy attached. So rather than giving you a fixed credit, they take effectively what would be the fixed credit strategy, and then they go invest that in call options. And then based on the price of the call options and what the fixed crediting would be for the options budget, they then take that and they go buy call options, and that gets you what the cap rate is. So the 0% floor, maybe 10% cap, something of that nature, and you are able to participate in the market that way. That's where they come up with the story, upside potential, downside protection, but they're really just taking the fixed crediting and speculating with options. And if you could do that well, and if the insurance company could do that for you and be that profitable, and it was that solid of a strategy, they would be doing it for the entire general fund. If they could get you better returns and squeak out better returns than they could do in the general fund from a long-term perspective with no risk or minimal risk, a risk tolerance within the spectrum of what we should be thinking about utilizing inside of a properly designed life insurance contract, the life insurance companies would be utilizing this for a greater part of the portfolio. They don't, they can't, and the reason they can't is because from a technical perspective, this option strategy is called a hedging strategy, and there's more risk involved with the hedging strategy, so it goes against the rules of which the insurance companies are allowed to operate with inside of the general fund. It doesn't make any sense. So hopefully that answers the question. If you have any questions about anything else, comment in the comment section below. I'll do my best to engage with every single comment I can. Till next time, have a blessed, inspirational day. We'll talk soon.